Hey everybody, Brian Shannon here from alphatrends.net. Today's Friday, the 7th of February, 2014, and we had a very interesting week here. Let's take a look at the numbers. The S&P 500 actually was up 0.8% for the week. The Nasdaq up 1.2%. Russell 2000 was the laggard, down 1.2%, and the rest of the indices were higher as well. So let's take a look at the charts here and see what could possibly be next. We are below a declining 50-day moving average, and that still gives us reason for caution. Here we look at this market and see we've got a declining 20 and 50-day moving average, and we've had a real strong rally off the lows here once we tested those on Wednesday, coming from basically 173.5-ish up to let's just call it 179.5, so 6 points. Real nice snapback rally, and if we take a look at the Fibonacci on here, you can see that based off the highs that we saw in January to the recent lows, we've retraced a little bit more than 50% of the sell-off, that is from the highs to the low. And again, we're now positive for the month. Year to date, we're still lower, but obviously the market erased quite a bit of those losses here the last 2 days. So looking forward, I think next week what we want to see is that what we should probably expect would be a little bit of resistance in this area. This seems like the likely area to find a little bit of resistance. Ideally, what we could see for a bullish scenario would be a pullback down, maybe even towards 178 or so. Let's take a look at the 10-minute time frame actually. 178, 178.5, somewhere in there. As long as basically this level holds, I think 177, we're still in recovery mode. So, but you know, we got a little bit ahead of ourselves. So if we can pull back a little bit, create a higher low, and then break this resistance, then that would put this market in for a test of this prior breakdown area near about 182, and we have that 50-day moving average up here as well. 50-day moving average currently at about 181 and basically about 181. So you know, it's really still in my mind a trading environment here. We made it through the earnings reports this week. You know, we still have a few of them, but the bulk excuse me, the bulk of the earnings reports from the fourth quarter have been released, and there's obviously been some great winners, the stocks such as Netflix, you know, real strong winner, and losers like Twitter we saw this week, gap significantly lower, recovered a little bit, but Twitter, you know, is still below this volume weighted average price since the stock came public, and I think that if you get some further bounce, that Twitter is likely to find some resistance up near that 57 level. Anyways, let's get back to the market and take a look now at the Nasdaq. The Nasdaq is in better shape. You can see here, that is in the S&P 500, that this prior area, 86.5 basically, and where we see the 50-day moving average, the market got back up above that. This had been prior resistance, which turned into support as well. Let's look at the 65-minute time frame, and we can kind of see that a little bit more clarity here, that this 86.5, what we'd be looking for in here would be ideally that we pull back and hold above that. I think even if we drop down maybe towards 86.25, that wouldn't be a bad thing, but a pullback, a pause that refreshes, and then some continuation higher would be the most bullish scenario for the Nasdaq. On the flip side, if we're to, you know, I think that a breakdown from here isn't likely to be a big fearful event, but instead we have some support below us, and that it should maybe turn lower to sideways. So this week, obviously, we had a lot of reasons to get you go from guilty till proven innocent to more neutral, and the area of bigger concern, I suppose, is the Russell 2000. Now, the Russell 2000 had broke its trend line, and you know, we had previously seen this real nice pattern of higher highs and higher lows with prior resistance turning into support on pullbacks. Now what we're seeing, however, is that this prior support acted as resistance, and we're going to have to see next week if this band of prior support between 111 and 111.5 acts as resistance, and the market continues lower from there. If that's the case, then we would have to be concerned that maybe the Russell 2000 rather is going to continue to lead this market a little bit lower. So definitely something to be aware of. And we'd seen, and I should go back to the S&P 500 in a moment as well, that it was a 150-day moving average and this trend line off of the December 2012 lows that that the Russell 2000 held, and the same which is true for the S&P 500, that that fourth quarter, right at the end of the year 2012, we've seen this trend line being tested, and that's also with the 150-day moving average. Now we have the Russell 2000, as I said, still kind of looking a little bit shaky here. So this is going to be a key battleground for the Russell 2000, 111 to a 111.5 next week. If we can get back above there and hold above there, then I think we spend some time in this area and then work towards that next level of potential resistance, where we had this support turn into resistance 2 weeks ago at about 113.75-ish. The semiconductors had a nice recovery this week. So for the week, the semiconductors were up just under 1%, and the daily chart's still kind of a mess. I mean, we came down to that 40 level and found a bounce in there. That's same thing here is basically the 150-day moving average in this trend line off the December 12 low. So these lows are going to be very important, I think, going forward. That is, if in the next month or so we break down below those, it could spell bigger trouble. For now, though, the semiconductors are back to an important battleground as well, and that's at 41.5 to 41.60-ish area that had been support for a good period of time back in December, and then turned into the resistance before we saw that next leg lower. So perhaps we continue up just a little bit into here, then pull back down towards 41. That would be a good scenario to create, again, a higher low for the semiconductors. A higher low would put us in a place where then the market could get back above that 41.60 and perhaps hold on to these gains and just digest a little bit more through time, rather than seeing this market drop back down below 40 and see things unravel. Now, I don't think that's very likely to occur next week, that we would break below 40, but the lows that we saw this week in all these markets are going to be important to mark against going forward, because we had broken important levels of support. And looking at the financials, you can see that important level was the 21 to 21.10 we had been speaking about for a while. We found some support there a week and a half ago, only to break it this week. But that was a short-lived breakdown. As we broke the support, it continued to drop lower, but then recovered. So it's not just about breaking down, but if you're short over here, nothing wrong with a trade like that. But once it creates that higher high with a higher low, then you have to at least cover your short and reassess. Now the reassessment process in here says we would expect that this area, 2130 to 2140, is likely to offer some resistance, and if that's the case, then what we would look for, the most bullish scenario would be to pull back, create a higher low. That might also get people excited about an inverted head and shoulders pattern, and we'll see if that materializes or not. But the point is, we're in an area that's likely to encounter resistance. It's not resistance because the market hasn't turned away from there, but we have the potential that it can offer resistance. We've just seen this market rally from 20.5 up to 21.30, so a decent little percentage move in there of about 3.5–4%. Now a pullback, a pause that refreshes it, catch along a rising 5-day moving average, would then put us in a position to be able to break through, hopefully, that 2140-ish level, and then we would go, we'll look for the next level of potential resistance up here at about 2170 to be tested, and if that's, then we would look for to see how well it holds that level. So for now, we're cautiously looking for this market to recover a little bit next week, but I think that first we would want to see that this area where these markets are would in fact offer a little resistance. Maybe we get up to 2140, 2145, then pull back. I wouldn't want to be buying above this level because it's already, you have to ask yourself, where has it come from? It's just had a nice little rally, 3.5–4%. So a pause that refreshes would be much more bullish, much better for the health of this market, and then it would be in a position where potentially we could be able to continue to rally higher. Bonds this week sold off a little bit. The TLT, you can see here, which represents the average 20-year bond, was 1.3 down 1.37%. Now on here, what we saw was that we came up to the declining 200-day moving average and this prior area of where we had seen prior resistance. So it looks to me like bonds probably will filter back down towards about 105-ish, and then we'll see if this level of prior resistance in here does in fact hold a support, and that the recovery in bonds could possibly continue. For gold, I think kind of the same thing. We've got an important level of resistance that this market is testing. We've got this little trend line it's testing as well. We've got that 100-day moving average. I still think when you look at the longer term chart of gold that it's still in a primary downtrend, and if they don't scare you out, they'll wear you out. So if you're long, I'd say, be aware of where you get out. And I think below the 50-day moving average, below about 119 or so, would say it would be time to get out of gold if you're long it. Personally, I don't trade gold. I don't really have much interest in it beyond making mention of it because people ask me about it all the time. Shares of Apple, of course, we saw them gap lower and sell off for a few days. News came out that Apple is buying a lot of their stock back, and it's still, in my mind, a broken stock. I would expect that this prior support would encounter some resistance, and that trades in Apple, there's been some good swing trades, I suppose, but I consider it more of a day trading stock, really, with the bigger ranges we see in there. So if you're involved in it, I'm glad you're making money in it off of that purchase, but be aware that it's likely to encounter some resistance up in this area, and just know where you're willing to get out to lock in your gains. That'll do it for me. I hope everyone has a good weekend, and I'll talk to you next week. Thanks for tuning in.